Hello and welcome to the SIA Wealth Management May 2023 Market Outlook webinar presentation. My name is Colin Cieszynski, Chief Market Strategist. Thank you all very much for joining us today. Today, we're going to focus primarily on market insights as we move into the spring. Markets have been kind of caught in a tug of war recently between continuing risks ongoing risks in the banking sector and some political risks in the United States with an otherwise strong economy. Earnings season was pretty good overall, but with that starting to wind down and news flow drying up, the traditional spring and summer seasonality appears to be starting to kick in. So some of the topics we're going to look at today included updates on the inflation and interest rates, looking at earnings season, seasonality and sector rotation, what risk markets is telling us about investor sentiment, international equities, and tactical investing. We're seeing now that the something that we've been watching for over the last year has been the closing gap between inflation and interest rates, particularly in the United States. And the US CPI is now officially below the Fed funds rate. And that's important because every major interest rate hiking cycle of the last 50 years did not end until Fed funds was higher than CPI, which it now is. So we finally, after a year of inflation coming down and US rates going up, have finally met in the middle. And generally speaking, it appears as though this broader rate hike cycle may be getting close to an end. The Bank of Canada has remained on hold into the spring, and the Federal Reserve Board with the green line, although they did raise rates at their last meeting, they're now only expected to go to either pause or maybe do one more rate hike through the rest of this year. Some of the other central banks are still catching up, and we did see in Australia where they had paused at a lower level and then had to resume rate hikes because they haven't quite caught up to where the US and Canada are. England is also getting close to where the US and Canada are as well, so we're keeping an eye on that, whereas the Europeans and the Swiss still have a ways to go in order to catch up. And the other thing why we're keeping an eye on as we continue to move through this is the question of, well, are we headed for a soft landing or for a hard landing? Or will the central banks be able to bring down inflation without causing a recession? In the past, it's been a challenge. We've seen that that past rate hike cycles have been followed by recessions and have been followed by significant declines in the stock market because of that. We look at the Fed funds peaked in June 2000 as an example. The Dow Jones peaked in December 1999, and it didn't bottom out until September of 2002. The Fed funds rate peaked in June of 2007. The Dow peaked in October of 2007, and the US market did not bottom out till March of 2009. Most recent cycle, even the short one that we had, Fed funds peaked in April of 2019, the Dow peaked in December of 2019, and with the pandemic, everything bottomed out in March of 2020, and then we saw the big rally up off the initial rally up off the pandemic lows. What's most significant about that, of course, is we've seen cracks start to emerge in the banking sector, particularly related to regional banks. So on the one hand, there have been signs that rate hikes have started to have an impact on the economy, but on the flip side, we're still seeing some fairly strong economic numbers, whether it's in particular employment numbers, but other things as well. We're coming out of the end of earnings season, particularly in the US now, and it was somewhat hit and miss. According to FactSet, by middle of May, 92% of S&P 500 companies had reported. Of those, 78% of the companies that did report had a positive earnings surprise. So that was pretty good. I mean, that was certainly encouraging that that earnings did come in better than people were expecting and or fearing. However, that being said, on average, earnings were down about 2.5% from a year ago, and that's the second quarter in a row where the earnings growth has actually been negative over years. So it's something to keep an eye on. Things aren't as bad as people were worried about, but they're not particularly great either. And also want to note the forward PE for the S&P 500 they mentioned was 18.0. This is pretty much in line with historical averages. And this is a theme I'm going to come back to a few times in this presentation is we're in kind of a neutral kind of market here where things could go either way. We're not extremely overbought, we're not extremely oversold, and we're just kind of bumping along within ranges. So I'm going to speak to this a few times in the presentation. Something else that FactSet had reported that was intriguing was this, which was that for the S&P 500 companies that reported, the ones that were more domestically focused with more than half their revenues in the US actually posted earnings growth of 2.7%. The companies that were more internationally focused with more than half their revenue coming from outside the US showed a decline of 10.2% in earnings. So this could be a combination of currency and weakness in international markets, particularly ongoing struggles in China and the Far East. And we've seen that, and I'll show it a little later as well in terms of how international equities have been trading. As I mentioned, we're coming out of the spring earnings season, and we're also coming out of what's historically one of the stronger times of the years in stocks. There's a reason why we have the old saying, sell in May and go away. And that's related to the fact that we often have seen historically, seasonally have seen weakness in May and June, and seasonal weakness again in between about the middle of August and the middle of October. And both of those are kind of in between earnings seasons. And interestingly, historically, we've had an earnings related bounce in July. To start the year, the markets have been kind of all over the place. We had a strong January, a very weak February, pretty good results for March and April. I'm looking at the green bars for 2023, but so far in May we have seen some a bit of weakness once again. But this, to be honest, has been day to day. We've had very weak days followed immediately by strong days, and it seems as though it feels a lot of ways like it's a market right now that's still kind of trying to find a direction. And the sector scopes tell us this as well. This is the bullish percent for 31 industry groups, which is the percentage of stocks in each of these sectors that's on a bullish technical signal. The ones on the right have a higher bullish percent, are stronger. Ones on the left have a lower bullish percent, are weaker. And we can see that for the most part, the biggest cluster is right around the middle. So again, we're not extremely overbought where they're piling up on the right. We're not extremely oversold where they're piling up on the left. We're kind of in this mushy middle. As we look at the actual sectors, we can see that some of the weaker ones are banks, financials, energy, and semiconductors. Semis had been strong to start the year, but had a correction in recent weeks, whereas the other ones have had ongoing struggles for quite some time. As we look over on the right-hand side, we can see construction doing quite well, which is indicative of a generally positive economic environment. But then some of the other sectors are more defensive. Utilities, health, food are more defensive sectors, which suggests that sentiment might be optimistic around some sectors, but there's still quite a bit of caution and concern out there as well. Something else I wanted to look at was the market breadth. We've been getting a lot of questions from advisors about how are the markets doing, and so what we've been seeing though is that there are gains in the market this year, but they've been concentrated in a fairly small number of companies. This doesn't appear to be a rising tide lifts all boats kind of situation. This is a very much more tactical, large difference in relative strength and large divergences between stocks and sectors. So at the close on May the 15th, the S&P 100 index was up 12% year to date. Out of the 100 stocks in the index, 24 of them have returned more than the index. So that means that about a quarter of the stocks are pulling up the market and driving most of the gains. In fact, if we look just at how many are profitable year to date, 54 out of the 100 companies in the S&P 100 are actually profitable year to date, and 46% are losing. 46 stocks, or about 46%, are losing money year to date. So it's not it's a very mixed market. I've shown that in that kind of neutrality, but it's very mixed. There's stocks and sectors that are doing really well. There's stocks and sectors that are doing really poorly. The median stock in the index, 50th rank based on year-to-date returns, is about 1.5%. And for what it's worth, the stock was Texas Instruments, just for anyone's interest. The best return year-to-date, Meta Platforms, has almost doubled. And the worst return year-to-date is Charles Schwab, down about 38%. So as I mentioned, there's some pretty extreme divergences in performance this year between the highs and the lows, and at the same time, it's very mixed between whether stocks and sectors are profitable or losing money this year. So it's a tough year for markets, for investors trying to make money in the market. But that being said, there have been a lot of relative strength opportunities to capitalize on as well, taking advantage of areas that are showing strength and avoiding areas that have been showing relative weakness. And we can see this in the sector action as well. Year to date in 1 month returns up to May the 15th, strongest gains have been industrials, information technology, and then with gains of about 9% year to date. And then the next tier with gains of around 3 to 4% are the defensive consumer staples and healthcare. What we are seeing is in terms of weakness, losing sectors on the year, energy and financials have struggled the most. And just something I did want to point out as well, as we look at tech, for example, is that if we look, for example, at technology, at communication services, and at consumer discretionary, although those sectors are and materials, although those sectors are up year to date, they've also had significant corrections within the last month. So we have had sizable swings. Things aren't going straight up and haven't generally been going straight up or straight down. We've had some fairly large swings in both directions, even in sectors that have shown relative strength and positive returns this year. I just wanted to highlight a few charts as well here. First of all, as we look at the relative performance of the Dow indices, the industrials, the transports, and the utilities. The Dow industrials have basically been flat for about 6 months now. The transports, which is the orange line, have been up and have been down, and the utilities, which is the blue line, have had more moderate ups and downs, but again, they're kind of range bound and kind of flat as well. So we're seeing a lot of range bound swing trades kind of happening as we look at major indices. The U.S. banking crisis appears to be ongoing, and so first I wanted to highlight at the top, the gray line is the Canadian banks are actually positive year to date, and they've generally did not fall as much during the March crisis and have been basically recovering fairly nicely through. Now, I will note that next week we get Canadian bank earnings, so we'll see how this, what happens with, how does the market respond to those, particularly for the banks that have more exposure to the United States. We'll be keeping an eye on that over the next coming days and week or so. The insurance and brokerages, the blue and orange lines, kind of sold off in March, and since then they've been flat. And but as we look at the national and regional banks, the purple and black lines at the bottom, they're still in a downtrend. They sold off and they've continued to kind of drift downward. We're seeing signs in the last couple of weeks that maybe they're starting to stabilize, but it's too early to say for sure. We're still the jury is still out on them. Technology action has been quite mixed as well. The purple line, the overall tech sector, has done quite well and continued to climb. But if we look at the orange line, which is the semiconductors, we can see that it's been much more variable. We had a good rally, we've had a big sell-off, where some stabilization, maybe bouncing again. And similarly with the social media group, we've seen significant ups and downs as well. So even where we have a sector that overall appears to be doing well, even underneath the sector and the subgroups, we can still see some significant variations in performance. Looking at the risk markets, as I like to call them, places that people tend to look to during times when they're feeling more enthusiastic and tend to avoid when they're feeling a little more cautious. I've noted technology has been an outperformer, and we're seeing that in the NASDAQ, which is the orange line, has continued to do quite well. The emerging markets did well around Christmas, when people thought that China was going to start rallying and then recovering, and then when it didn't recover as fast as people thought, it's tumbled back down again. That's the blue line, emerging markets. More recently, it's been kind of flat and steady. The other one that's kind of has been going nowhere is the Russell 2000. That's U.S. small cap stocks. That's indicative that there's not a lot of breadth in the gains of the overall indices. It's a smaller number of large cap stocks. We're not getting that wide participation that you would see if the Russell was moving. And so that's important. That's also another just an indication of we're getting these swings up and swings down, but the overall market is really just kind of spinning its wheels. The US dollar versus the S&P 500 index, we're seeing that up to October of last year, we had a rising US dollar and a falling US stock market. Since October, we've had a falling US dollar and a rising US stock market, and that trend so far just appears to be continuing. Investors are kind of looking and appear to be thinking that the rate hike cycle is probably close to an end. The wheels haven't fallen off the economy yet. We're still keeping an eye on it. People are still cautious, and we're still watching it. But for now, we're seeing the dollars coming back down. That's also helpful for U.S. corporate earnings as well, and that's certainly helping to boost the U.S. stock market. Now here, this is a looking at international indices. The gray mountain part of the chart is the S&P 500, which we're kind of comparing everything else against. And so what we're seeing here is in particular the blue line is Germany, and that's Europe. Europe has continued to do very well. The purple line, UK, has been doing very well. Canada, the orange line, is kind of tracking pretty close to the US these days. And when I noted before the emerging markets, I'll note Hong Kong. It was the same sort of thing. It rallied back November, December on anticipation that China's reopening would spark a rally in the markets, and then when that fizzled, so did the market. And more recently, it's just kind of been trading flat to slightly lower at this point. They're maybe starting to bounce, but again, it's too early to really be able to say. And we're just going to highlight our SIA charts. Equity action call remains in the green favored zone. It has softened a little bit over the last couple of months, but it still is within the green zone. This is a measure of global equity market risk, money flows, and overall price action changes. So again, I note this still is in the favorable area for equities. And finally, I'll remind everyone of the tactical changes we made over 2021 to 2023. At SIA Wealth, we do use tactical, and we do tactical investing, and we do adjust the amount of equity participation in portfolios. Since November, and we went from almost 100% in early 2021 down to 0 by the middle of 2022, back to 100% equities by the end of 2022, where it has remained. We've been in risk on markets, and as such, the portfolios have remained fully invested since November. We will just wrap up here with our fund codes. So at this point in time, the overall feeling, sense from what we've seen from looking at charts is we're not ridiculously oversold, we're not ridiculously overbought, we're kind of neutral. We're heading into a bit of a softer season on a seasonal basis, but overall the general trend appears to still be sideways, and we're seeing more of swings within ranges rather than trends, and significant differences in performance, which does it's still supportive of tactical investing and of a focus on relative strength and trying to keep to areas that are showing a stronger performance. We'll finish up here with our disclaimers as well, and we thank everyone for joining us today, and we look forward to speaking with you again next month. Hope you have a great day.